Friday, October 6th. The first week of every month is distinguished by the freshest reports from the immediately prior month. Unfortunately, hurricanes have reduced these reports to street debris. Some of them are coming in much stronger because they reflect the extraordinary migration of labor to hurricane zones, the drawdown of supplies, the new ordering of supplies, and others they knock the knees out from under, such as job reporting, in which nobody went to work in significant parts of the country during last month. Anyhow, I'm paying attention to anything that came out in this last week. Markets assume that everything is operating on trend line. The big deals going on now, I mean, it's still the Fed, and not so much what the Fed is going to do as next year, who may do it, who the next Fed chairman may be. And I don't think even that's so much in play. The events in the economy confine the Fed to tracks. If an unfortunate person or persons wound up as Fed governors and they got off track from any length of time, in today's markets would punish them in hours. And anyhow, I'm not really worried about that part of it. The Fed is worried. The Fed is concerned. It doesn't understand why we don't have the beginnings of inflation and wage growth, given how tight the labor market is. But there's another issue that can happen to the Fed, especially when it's been on a big stimulus move, trying to get the economy out of something ugly. And that is, if the Fed gets too much cash out in the economy, we can wind up with assets going up in price. Now, that's not inflation. It's a bubble of a kind. And there are some peculiar movements out there that are enough to make the Fed, I think, certain to raise its rate in December, unless something ugly happens between now and then, and probably to stay on track to continue to raise rates next year. And still preemptive, not trying to slow the economy down. But the oddities are, this week, we had news stories all week long that were the kind of thing that would upset the stock market. Mr. Trump is persistent in these cute hints about his plans to obliterate North Korea. And we can't tell how much of it is gamesmanship and how much of it is real. We have Europe is in an awkward moment with Catalonia attempting to secede from Spain. The democratic heritage in Spain goes back, almost 30 years. There isn't one, and there are centrifugal forces in play. The administration is going to repudiate the nuclear agreement with Iran. There are plenty of news stories that should have given the stock market some hard days, and instead just a new record. The stock market was up 100 points day after day during the week, and that doesn't quite make sense. Another characteristic of financial markets which are reacting to just too much money lying around is the advent of cryptocurrencies. The first was Bitcoin. And Bitcoin may have a future. Embedded in Bitcoin is a pretty good system for settling obligations. But there is a new form of cryptocurrency, which is a bunch of wild people in Silicon Valley are going to take a new venture public. It doesn't have any revenue. It doesn't have much of a future. But instead of an initial stock offering, known as an IPO, the new deal now is an initial currency offering, which instead of stock in the company, you get some crypto make-believe money, which you can move around with your computer and fiddle with. And the growth of these initial currency offerings is doubling every 90 days, a little more than that. We had twice as many in the last 90 days as we had in the prior 6 months. It's not a lot of money. It's only $1.3 billion in the last 90 days. And that's not enough to destabilize the economy, but one of the signs of too much money lying around, as the copy next to this video concludes, is when the Wall Street boys begin to light cigars with $100 bills, look out. On that thought, good weekend.